and welcome back to Dukascopy TV. Today I'm joined in the studio by Thomas Veillet, and we're talking market reactions to yesterday's US election results. Thomas, thank you very much for joining me today.
Thanks to you.
Now, many people think that Obama and the markets have this relationship that's positive, even going as far as saying that they're best friends. Was this reflected in the way that the markets reacted to yesterday's election results?
Yeah, that was quite a surprise. The fact is, many people are thinking that the market reaction is mainly due to the election. And I think there is a 50% reaction. First of all, there was Draghi who was speaking yesterday, and he said that Germany is not going that well, and the economic crisis in Europe is also starting to go in Germany. It's not a surprise, but the fact that hearing Draghi saying that, people were scared. Then you had the fact also that suddenly we got all this waiting time saying what's going to happen with the new presidency in US. Will it be again Obama or will it be Romney? There was this uncertainty in the market. Right now, they don't like uncertainty. They need guarantee. They need to know where they are going. We are very afraid about what's happened before, and now we are trying to get answer about the future. And when finally we got the answer of Obama, at the beginning that was like a good news. Okay, nothing changed. We are on the same path. We're going to stay on the same way, and maybe we're going to start the work that has been done. We are going to continue the work that has been done for the rest of the last 4 years. Then suddenly the market was starting to think, okay, we got Draghi. Maybe Romney would have been better because he understands better the business. As we think, we don't know. We think that he might have been better. And there is also the fact that the next problem will be the fiscal cliff. And suddenly we are starting to think and say, okay, we are half of November, and in 6 weeks we have to find a solution for this fiscal cliff problem. And so far we don't know what's going to be. We are almost sure that we're going to find something, but so far we don't know which way it's going to be.
I see. And just looking at the market reactions in more detail, how did gold react? Because gold was virtually flat on Wednesday. How much was the US results sort of lessened by the fact that there are so many European woes?
I got the feeling that, the gold is has always been like a secure asset, so people want to buy gold when it's not going well in the economy. But I think it changed for the last few years. Gold has become like a trading product, like any other product, like the oil or like an equity or any ETF. And suddenly we know that the gold is going higher. That's almost like 100% sure. People know that the gold is going to be higher and higher and higher. They got target like 2,000 by the end of the year, and getting very short to get to 2,000 in the next 6 weeks. So there is like a feeling that nobody wants to trade any more gold, because first of all, most of the clients they have already gold in their portfolio. So why they should increase the position first of all. And the second one, that there is also very big player who have a huge position on the gold, like big hedge fund manager, like Paulson, for example. They have this kind of huge position, and they are not going to pile up more right now because they are scared as well. And that's maybe, so far, people are not trying to take any more risk on the gold, so that's why nothing's going on.
I see. And just looking at oil as well, because oil's been on a sort of, if you will, slippery slope down since mid-September. Yeah. What happened to oil on the results yesterday?
In any product right now, people are just trying to play the short time. They are trying to play a bounce because it's going to be Romney or Obama. It's not coming, so they sell it, and nothing's going on. So it's a very short-sighted, and people, they don't want to go too fast and to fully invest in something, and they're for sure not going to stay in the same asset for the next 6 months, because they think that maybe in 2013 it's going to be better. So that's why people try to play a short bounce, because election, or because dollars, or because euro, or whatever reason you want to take. And as soon as they've seen that it's not going to happen that much easier, they sold everything.
I see. Now, Thomas, thank you so much for your insights. We're just going to go on lastly to the Dukascopy question. We ask every guest that comes into the studio, if you had $1 million to invest in the market for 1 year, where would you put it and why? So we're just going to have a look at your options here.
Basically, for me it's going to be the easy answer, because equity is my field of expertise, if I could say that like that. So I'm feeling very comfortable, just because I'm positive on the fact that we are on an economic crisis. It's going to be very tough to get out, but most of the stories may be priced. And I think that as soon as it's going to be a little bit quieter and people start to build again more confidence, we're going to get back in the equity, because I don't see more interest in the other assets. There is some interest for sure, but I mean, oil and gold for me, it's too 100% sure it's going to go higher, because everybody thinks that's going to go higher. Real estate is going to be a big question mark, because it has to rebound at a certain point, especially in US. And if real estate is starting, equity is going to follow. And bonds, there is no point to be in bonds right now for me. So that's equity. And by chance, this is my field of expertise, if I say that.
Well, thank you, Thomas, for coming in and sharing your expertise with us here today. Thank
you very much.
That's all from us here in the studio, but just click back to the website for more interviews and updates. Take care.